Right now, as of 9:46 a.m. on this volatile Tuesday morning, December 9th, 2025, SMX, Security Matters PLC, is trading at exactly 106.88 US dollars. The screen is flashing red with a decline of $28.94, translating to a steep drop of 21.31% for the day so far. If you are watching the ticker tape, you are likely seeing a massive amount of volume churning through this level. And for the uninitiated, this looks like a disaster. A 21% haircut in the opening hour of trading usually signals a fundamental break in the business thesis or a catastrophic earnings report. That is the expectation. The market sees a double-digit drop and assumes the company is collapsing, or that the recent rally was a pump-and-dump scheme engineered by shadowy chat rooms. However, the reality of this specific movement is far more mechanical and, dare I say, structural. What we are witnessing is not a collapse of the business model, but a violent repricing following the massive volatility event triggered by their recent 1-for-8 reverse stock split and the subsequent capital injection news. The drop to 106.88 is the hangover after the euphoria, a necessary flushing of the short-term speculators who piled in during the pre-market mania. When you see a stock like SMX move this fast, you have to ignore the percentage sign for a moment and look at the market cap and the float. After the reverse split that became effective recently, the supply of shares has tightened dramatically. This means that relatively small orders can gap the price up or down significantly. If you are trading this on a mobile app like the Robinhood app or monitoring the Level 2 data on an interactive broker's trading platform, you will see that the bid-ask spreads are wider than usual. This liquidity vacuum is what exacerbates moves like the one we are seeing today. The expectation is that smart money is fleeing. The reality is that smart money is likely sitting on the sidelines, waiting for the volatility to contract before building a position for the next leg of the company's life cycle, which is focused on commercial scaling rather than just survival. To understand why SMX is trading at 106.88 and not in the pennies where it used to reside, you have to look at the broader context of what this company actually represents in the market. It is often compared to tech plays, but it is really a material science play masquerading as a blockchain company. While investors obsess over Tesla stock for its batteries or Apple stock for its consumer ecosystem, SMX is trying to become the DNA of the physical goods economy. The drop today is partially driven by the fear of dilution. The company recently secured a significant equity facility, over $100 million. In the world of small-cap stocks, equity facility is often a code word for, "we are going to print shares and sell them to you." This fear is what is driving the price down to 106.88. Traders are front-running the potential selling pressure from that financing deal. But here is the contrarian take. That money removes the immediate bankruptcy risk. It gives them a runway. The market is pricing in the dilution, the bad news, but ignoring the capitalization, the good news. Let's talk about the trading psychology here. If you are holding this stock in a Fidelity brokerage account or managing it through a self-investing strategy, you are probably feeling the heat. A 20% drop triggers stop losses. It forces margin calls. We are seeing a cascade of automated selling right now. But once those forced sellers are out, who is left? The long-term believers and the institutions that want exposure to the circular economy. SMX isn't just selling security, they are selling traceability. In a world where the European Union and other major governments are mandating digital product passports, SMX's technology, which allows physical objects to be tracked on a blockchain via a molecular marker, becomes not just a nice-to-have, but a regulatory necessity. The market is currently treating SMX like a meme stock, but the regulatory environment is treating it like a utility. This disconnect is your edge. The recent reverse split was a crucial moment. By consolidating shares, they regained compliance with NASDAQ listing requirements. This was the first hurdle. The expectation was that after the split, the stock would just drift lower again, which is the typical pattern for distressed companies. However, the stock showed surprising resilience and even rallied hard before today's pullback. This suggests that there is a new base of investors who were waiting for the compliance issue to be resolved. Whether you're using Schwab Intelligent Portfolios for your passive money or actively trading on a Fidelity trading platform, you know that institutional mandates often prevent funds from buying stocks under $5 or stocks that are non-compliant. Now that SMX is priced well above that threshold and is compliant, it opens the door for a different class of shareholder to enter. The selling we see at 106.88 might be the old guard of penny flippers leaving, while the new guard of growth investors hasn't fully stepped in yet. Let's go deeper into the technology because this is where the expectation versus reality gap is widest. The expectation is that SMX is just another QR code company or a glorified sticker manufacturer. The reality is that their tech is molecular. They take a unique chemical signature, imagine it like a liquid DNA, and they embed it into raw materials. They can put it in plastic, rubber, metal, or even gold. And once that marker is in the material, it's there forever. You can melt the plastic down, recycle it, turn it into a shoe, then a bottle, then a park bench, and the SMX scanner can still identify the original source of that material. This is mind-blowing stuff. It solves the biggest problem in recycling: contamination and verification. Everyone says they're using recycled ocean plastic, but nobody can prove it. SMX can prove it. This brings us to the greenwashing crackdown. Governments are tired of companies lying about their sustainability. If a sneaker company says their shoes are 100% recycled, they better be able to prove it. SMX provides that proof. The recent drop in share price ignores the looming catalyst of the plastic tax in Europe and the UK. Companies are going to be taxed heavily if they cannot certify the recycled content of their packaging. SMX is essentially selling a tax shield to these massive conglomerates. If you view the stock not as a tech company, but as an insurance policy against environmental regulation, the valuation at 106.88 looks very different. Now, I want to pause and ask you directly. Comment below how many shares of SMX you currently hold and whether you held through the reverse split. Did your broker handle the split correctly, or are you still seeing weird numbers in your account? It is common for platforms like Robinhood Crypto, which also handles stocks, or SoFi investing apps to take a few days to fully adjust the cost basis after a corporate action like this. Hearing your experience helps us gauge the retail sentiment and confusion levels out there. We need to address the competition. You might think, why can't NVIDIA stock or some other tech giant just do this? The answer is that this is chemistry, not just code. It requires physical labs, chemical patents, and deep integration into the manufacturing supply chain. You have to be on the factory floor, injecting the marker into the vat of molten plastic. That's a messy, physical business that pure software companies avoid. SMX has spent years building these relationships and piloting these programs. The barrier to entry is higher than it looks. While you are browsing investing sites looking for the next AI play, you might be missing the hard tech plays like this that are solving physical problems. The intraday chart right now is showing a bear flag formation, which usually implies more downside in the very short term. The 106.88 level is precarious. If it breaks 100, we could see a psychological flush down to the 80s. However, if it holds 105, we could see a squeeze into the close as day traders cover their shorts. The volume on the selling is high, but it is decreasing compared to the open. This volume decay suggests that the panic is subsiding. If you are looking at Fidelity ETFs or other broad market instruments, you won't see this kind of localized drama. This is specific to SMX and its unique situation. One of the most interesting aspects of SMX is their focus on the gold and precious metals market. They have a joint venture called True Gold Consortium. They mark gold so you can trace it from the mine to the refinery to the jewelry store. This ensures the gold isn't from conflict zones or using illegal labor. With gold prices at historic highs, the premium for ethically sourced gold is real. The market expectation is that this is a niche project. The reality is that the entire jewelry industry is terrified of the blood diamond narrative spreading to gold. SMX offers the antidote to that fear. Let's talk about the dilution spiral risk, because we have to be honest about the dangers here. The reason the stock is down 21% is that investors have been burned before. SMX has a history of raising capital at lower and lower prices. The death spiral financing is a real threat for small caps. If they keep issuing shares to pay the bills, the stock price will structurally decline regardless of how good the tech is. This is the reality that might actually be worse than the expectation. If management cannot turn these pilot programs into massive recurring revenue contracts soon, the 106.88 price will be a distant memory, and we will be talking about the next reverse split. This is why it's a high-risk play. It is appropriate for a speculative corner of an individual brokerage account, not the core of a retirement fund. However, there is a